Good morning, good afternoon, and good evening. Welcome back to the It's Attainable Real Estate Investing Show, episode number 15. Today, we're going to answer the question that everybody always has. Is there a such thing as a safe investment?
Welcome to the It's Attainable Real Estate Investing Show, where you will learn about investing, the power of real estate investing, and how to invest in it. Whether you have the time or even if you don't, you're going to see it's attainable either way. And now your host, who always wants to share knowledge with you, Christopher Balcom.
So, is there such thing as a safe investment? Well, it depends on how you define safe. The dictionary defines safe as secure from liability to harm, injury, danger, or risk. I don't think we have to worry about harm, injury, or danger, but what about that risk? No investment comes without risk. It says it right there in the dictionary. Secure from liability to harm, injury, danger, or risk. So don't let anyone tell you there is an investment with no risk. By definition, we can't invest and call it a safe investment without risk. So maybe we can't remove the risk altogether, but maybe we can lower it. Maybe we can mitigate the risk. When you think about risk, you think about losing it all. You gamble or you invest and you lose it all. It's all gone. You may also think about the ups and downs, and we call that volatility. So there may be some ups and downs similar to risk with investments, and also similar to risk, we can't remove all volatility or guarantee there won't be any volatility, but maybe we can reduce the volatility. So if we can reduce the risk or mitigate the risk, and if we can lower the volatility, would that make an investment safer? I think so. We're going to come back to this in just a moment. So when you think about investing, you think of risk, you think of the ups and downs. What comes to mind also with investing? The first thing that comes to my mind, or at least it used to, is the stock market, the publicly traded stock market that you hear in the news and see on TV each day. I want to say it's kind of ironic because back in episode number 2, or show number 2, I talked about the stock market. I think the show was called Introduction into Investing. So something different besides just your savings account. And I say it's ironic because back then that was pre-COVID-19, and I talked about the last 20 years in the stock market. That's a whole lot of data. And over those 20 years, there were some really high highs, like highs and with returns in the 20% areas, and there was some really low lows, like lows in the negative 38% areas. And with 20 years being a lot of data, I broke it down into 5-year segments. So I looked at the year of 2000 to 2004, and it was negative 2 or negative 2.2%. And then 2005 to 2009 was about 1%. And then 2010 to 2014 was 13% approximately. And then 2015 to 2019, just last year, was 10%. The average returns over those 4 or 5 year segments, or 20 years, was 5.59%. I believe back then in episode 2, or show number 2, I shared a chart, if I recall correctly, and the chart showed some of the ups and downs of the stock market. And looking back at that chart, you could see that just about every 10 years, there was some type of what we call now a reset in the market, but there was some type of downturn in the publicly traded stock market. So in 2000, there was a downturn. In 2008, 2009, 2010, there was a downturn. And then in 2019, many people, or some people, had predicted some type of downturn. There were some data metrics that might show that something was coming or we were about due for a reset. But also there was a lot of financial data that showed things were really looking good. Things were really continuing to rise. Organizations, companies, businesses were doing quite well. Unemployment was down. There was really not a lot to show that things were headed toward a downturn, besides some speculation, and then also the idea that we were about due for one, because generally every 8 to 10 years, there's some type of reset or downturn in the market. And we were getting beyond that 8 to 10 year mark. But boom, out of nowhere, COVID-19 arrives and hits all of us. And the economy comes to an immediate halt, an immediate stop. I mean, COVID-19 has affected all of us in some type of way. It has harmed the health of people. It has taken many lives. And from a financial perspective, again, it brought the economy to an abrupt stop. Businesses closed. People were out of work. People still are out of work. Unemployment reached a very high percent. And when you look at the stock market, it paints a picture of exactly that. Date by date, a timeline of events. When you look back at 2019, the performance of the S&P 500, and the S&P 500 being a market index or an indice, thought to be or considered by many as a good representation of the performance of the U.S. stock market. It's the performance of 500 large companies listed on the stock market or the stock exchange in the United States. So again, thought to be a good indicator or representation of the performance or health of the U.S. stock market. So the S&P 500 was up 28% in 2019. And besides speculation, and again, the idea that we were about due for some type of reset or downturn in the market, and a little bit of data out there showing that there may be a reset or some change or some downturn in the market coming, outside of that, one would have expected to have a good year in stock market performance for 2020. But on February 19th, which was at that time the peak for the S&P 500, just 9 days later, the S&P 500 dropped 12.76%. So 12 to 13% it dropped in just 9 days, with the talks of the coronavirus or COVID-19 coming to the U.S. or affecting the U.S. or affecting those even outside the U.S. as well. Just the thought that there's a virus that could potentially have the impact that it has brought to us today, brought the market, the S&P 500, down 12 to 13%. And then just 10 days after that, another 7%, it brought the S&P 500 down. And then overall, from February 19th to March 23rd, 33 days, the stock market or the S&P 500 performance, that indice, dropped 33%. So in 33 days, it dropped 33% in value. That is just unfathomable. Talk about risk. Talk about volatility. How do you mitigate that? How do you plan for that? A 13 or 12 or 13% drop in 9 days? You may not even look at your retirement account or your IRA account every 9 days. The statements are typically issued quarterly. Well, in just 1 month, 33% of the value is gone. So looking at it a quarter later is too late. Now, in the stock market, the loss doesn't happen until you sell. So if you have stocks or mutual funds or different investments in the publicly traded equities or stock market, the loss doesn't officially happen until you sell. Just like the investment doesn't happen until you buy. So how does this impact you? Well, outside of just the sure risk of all of this potential volatility, this is where most retirement funds are. This is where your 401ks and your IRAs, this is what many of those retirement accounts rely on. And outside of those retirement accounts, this is where the chunks or portfolios of many individuals' dollars are. Can you rely on that? Can you trust that for your retirement account? Do you want to trust that for your retirement account? Or do you want to rely on that solely, maybe is the question, for your retirement account? If you were going to retire in January, then great. But if you were going to retire in March, you would have lost 30% of your retirement. Or if you were going to withdraw some of your retirement funds to start to live on, 30% of the value would have been gone from some of those investments. That's unbelievable. That's too risky for me to have all my eggs in one basket. And maybe one basket isn't the problem. It's just that the basket has so much volatility. So what do? Well, find more baskets. Find more baskets to spread your retirement or your investments. And ideally baskets that don't have as much volatility. Maybe you have some of your retirement account or some of your portfolio or some of your savings maybe in the stock market, but maybe it's time to find an additional basket and an alternative investment that does not historically have the volatility that the publicly traded stock market or equities market has. So when I look at our multifamily apartment buildings or multifamily apartment communities or our multifamily investments, thankfully so, they have been nearly untouched. First of all of our tenants and their families are live and healthy, and they and their families are doing well. And after that, they have been able to pay their lease payments, all mostly on time. And we have just 2 delinquencies. Families that are, again, first and foremost, live and healthy and doing well, but had some financial impacts to their family. My peers in this industry are seeing similar. So a little bit of delinquency, a few late payments, but by and large, these investments are holding up well. The 2 delinquencies that we have are about 6% of our income for the year and about 2% of our return on our investment for the year. But it's still a great return, just a 2% reduction potentially for the year. And that would be if these tenants were delinquent 6 months, which they are not, but if they were, that's what we would be looking at. 6% potential loss of income for the year and about a 2% reduction in our return on our investment for the year. Compare that to 30% that we've been talking about that the stock market lost in 33 days. So what is 30%? What is that 33%? So if you had $100,000 in your retirement account or $100,000 in investments or your portfolio or whatever you were investing in the stock market, the publicly traded stock market or public equities market, 33% of it would just be gone. If you had $1 million you had investment in a retirement account or a portfolio of $1 million in the stock market, $333,000 would just be gone. It's like paper. It's just paper investments. It comes and it goes. It's given and it has been shown that it can be taken away. That is a far cry from real estate. Real estate is, not to be cliche, real estate is real. I mean, sure, the stocks that we invest in, the stock market that we invest in, those are companies we're investing in, and those companies employ people, and those people provide services or produce products, but that business is just so far from yourself. It's so far from me. We have no control in those investments. And to be transparent, because that's what this show is about also, depending upon the type of investment you do with real estate, you may not have any control in that investment either. But you will understand how it works. You see, it's a simple business model. I've said it before, there are tenants, and those tenants can be restaurants, stores, factories. And I have peers in some of those segments of real estate, but the investments that I can vouch for myself are multifamily apartment buildings, multifamily apartment communities, multifamily investments. The larger, the better. The larger the investment, the larger the risk, right? You might think the larger the investment, the larger the risk, right? But what if I told you the larger the investment, the lower the risk? Take, for example, in real estate, if you have one tenant and they can't pay, then all the income stops. But if you have 100 tenants and 1, 2, 3, 4, 5 tenants can't pay, there is still income from 95 other tenants. That's a good thing, right? That's the difference of paying the bills or not, paying the mortgage or not, having an income or not, having a return on your investment or not. Some businesses during COVID-19 have been called essential, so they stay open. Businesses like department stores, grocery stores, some restaurants. Well, having a home to live in is essential also. And most people treat it like so. For my family and I, and hopefully your family and yourself, I want to make sure that my family is healthy and safe and okay. And I want to make sure we have a place, a roof over our head, a place we can call home. And I prioritize that by making the agreed upon payments on my home. And our tenants in our multifamily apartment buildings have made it a priority to pay their leases for their home because it's important to them and important to their family. Our tenants' homes are important to us as well. And I always say as an investor, it's not just one-sided. You want to provide your tenants a great space to be in. And for us, investing in apartment buildings, that space is a home. So we pride ourselves on providing our tenants a great place to call home. If you can create an idea, provide something people need, that's going to be a good thing. Investing in real estate, and in particular for us, not just any real estate or not discretionary real estate such as maybe retail or restaurants, but multifamily apartment buildings and communities where people live, that is something that people need. So is there a such thing as a safe investment? I won't say anything is guaranteed, but you can see how there are some investments that have built-in risk reductions. And that's what we started with. Can we reduce the risk and make the investment safer? So why are there built-in risk reductions? What are those risk reductions? Well, it's essential. It's a need. It's not discretionary. It's not optional. There are lease agreements. There are mortgages. There's physical structures. There's buildings. Those items lead to less volatility. It's in the lease agreement that we provide a great home to our clients. It's in the lease agreement that our clients will pay for that home. It's in the mortgage agreement what we will pay our lender. Other investments, namely the stock market, because we've been talking about that today, the agreement is that your investment can disappear at any time. In 9 days, in 10 days, in 33 days, it could be gone. But in real estate, we have 1-year lease agreements, 2-year lease agreements, 20-year mortgages, 25-year mortgages. Those items reduce the risk at least a little bit. So what do you think? Would you trust your portfolio or your funds or your retirement in the basket of real estate investments? I did, and I have for years. But at least for these last 8 months, I'm sure glad I did. So what will you do? Not one day, today. Reach out to me. I want to hear from you. If you have questions about what we talked about in the show, or any other shows, or if you just want to leave a comment, or if you want to talk about bringing real estate into your plans, I'm at neelyrealty.com/podcast. That's NILEE neelyrealty.com/podcast. One last thing. If you found this show helpful and think it might be helpful to someone else, share the show with someone else. And I'll see them and I'll see you back here next time as we continue to see just how attainable real estate investing is.
You have been listening to the It's Attainable Real Estate Investing Show, sharing transparent knowledge on investing and the powerful impact real estate investing can have on your wealth and lifestyle. Follow or subscribe to the show using your favorite podcast app so you'll know firsthand when a new show is released, or visit neelyrealty.com/podcast and see the show there. That's NILEE realty.com/podcast.